Sven, great to have you back. I mean, are you characterizing this as a bear market bounce? Because that sounds pretty sizable for one.
It is, but hi, Carl. It's definitely not inconsistent, though, what we saw in the year 2000 and 2008. And as pervasive as this sell-off has been since January, with these various smaller counter rallies in between, we're still lacking kind of this classic bear market rally that is actually a lot more severe. And part of what's driving me here is basically a lot of the technical indicators now that have shown us to be extremely on the low end, an extreme side, be it BPNDX is at 7, components below the 200 MA at 7. These are not necessarily the lows, but it's certainly speaking to an imbalance in the market. And the weekly 50 MA is one of those that shows we're extremely far disconnected as we are approaching the weekly 200 MA. Now, that's one of those key classic moving averages also on the S&P. If you drop sustained below that, then all bets are off and things can get a lot uglier like they did in 2008. But we haven't crossed that yet. We may tag it. I'm not entirely sure if we do or not. But if we do, for now, all this suggests that we're setting up for a larger bear market rally if yields cooperate.
Right. That is a big if. I mean, how nimble would you have to be, Sven, to navigate that path? And is that something that you think individual investors would be wise to pursue if it happens?
Well, as active traders, we're obviously very disciplined with stop management. And so you got to be aware where the risk levels are and be able to then make an adjustment if you need to. From our perspective, within the next 2-3% or from here, we're setting up for such a rally. And again, I have to link this to the 10-year yield, for example. In May, we had a big rally off of the 10-year hitting 3.2%, then dropping, right? And now that the 10-year has made new highs, we see obviously new lows in markets. So they're very much intertwined. And interesting enough, yesterday, as we made these new lows, the 10-year dropped off of its highs, and it's also now in a new pattern that has me suggestive that eventually the 10-year is going to drop, and it has to drop because let's be absolutely clear here: yields this high is not consistent with a soft landing at all. The market needs relief on that, otherwise it's going a lot lower.
Right. So, Sven, you've been pretty critical of the Fed and Chair Jerome Powell. What did you make of that 75 basis point? Was it enough? What do you expect going forward to get those yields down?
Well, first of all, it's welcome, but it's been fairly late here. From my perspective, they should have started last year, basically, and they're dragging their feet. And now they're projecting a 3.8% Fed funds rate for next year, while at the same time insisting on positive GDP growth. I think that's a bit disingenuous because the market is already at the levels where the 10-year is at now, 3.4%, clearly signaling recession risk is strong. Second, while Chair Powell keeps insisting on a strong consumer and a strong economy, we are seeing significantly rollovers everywhere in the retail sales and Philly Fed, you name it, and housing, obviously. And even the Atlanta Fed's own GDP model has just dropped down to 0%. So my concern is that the Fed is, again, maybe misjudging or sweet-talking the economy vis-a-vis what's actually happening on the ground. And that, to me, that remains a risk factor that they're maybe now overdoing it on the other side.